Tonight on the Modern Kingsman podcast, business series, we're going to discuss the number one most hated aspect of owning and running a small business. How are we tonight, man?
Doing good. It's a lot of energy you got over there on that side of the table.
You know, I'm feeling really good, I'll be honest with you. Because tonight, we are going to free people from the most hated aspect of the job. And we are going to simplify it, tie a nice little bow on this whole thing, and make the worst aspect of this job so smooth they may not even dread doing it.
Smooth like butter.
Butter. Yeah.
Well, that was a big talk you got there going, but we're at least going to help you out on on this portion.
It's all about the sale, man.
Yeah.
All right, so the number one thing business owners hate to do in business is not customer acquisition. It is not marketing, because that's just talking about themselves. It is doing the books. Bookkeeping.
Really?
Absolutely. 100%.
Nah.
No. Business owners want to be out doing the work, not sitting in the office talking, not even talking, just writing down paper about the work and then reporting it to the IRS. They don't even want to do this. But this is very important.
Managing your money is the least enjoyable part of owning a small business. Is that what you're telling me?
Until you've got a lot of profit coming in, absolutely.
No, so today we're talking about how to manage your money as a small business. It's the next video in our series on how to start a small business. And today we're discussing specifically how to focus in on the finances and that, the systems that will help you be more successful in managing your money and your finances in that small business setting. Mm-hmm. So I think we dive right into it and we get into the numbers.
I love it.
And right now, we're going to get into number one. First point,
and I got to be honest, this is the one that business owners need to be bragging about here. You know what it is? Gross.
I'll never understand why that's the term that's used there, but that's another rabbit trail.
Yeah, I mean, honestly, it's probably because, man, this number would be so much better if the government didn't take so much of it. It's gross. So that's what I'm going with.
I feel like that's probably not right, but
let's call the IRS. That's fine.
No, so getting to know the numbers in your business. That's point number one.
Yes.
As a small business, you've established your company, okay? Whether that's a sole prop, LLC, whatever it is, you got your business established, okay? Mm-hmm. Maybe you've made a few sales, done a few jobs, whatever it is, you've started to make a few dollars. And now you need to figure out how to manage that money. And the first step in that is knowing where your money's at and where it's going. Mm-hmm. Where you sat last month, where you sit right now, and where you should be sitting next month. That's what we're talking about. And specifically, we're talking about net profit, gross profit, and overhead. Now, you can go a lot deeper than that, but for right now, that's what we're starting with.
I like it, man. Gross profit. I love it.
Mm-hmm. So, especially for a business that's just starting out, it's easy to just, I'll run my small business out of my own personal bank account. And I'll just, if I make some money, I make some money. That's fantastic. No, it's not fantastic. That's entirely the wrong way to be doing it. The correct way to be doing is have your own bank account, but we'll talk about that later. But running those reports that we just talked about to understand where your finances sit. So if you don't know, gross profit, is the total amount of profit that you made in a given time period, usually a month. Okay? Now, that's not the same as gross revenue, which that's the amount of total money that you brought in a certain month.
Mm-hmm. Gross revenue is where a lot of people get to brag. They're like, hey, I just did $1 million sale. Hey, did $100,000 sale.
I made $20.
Yeah. That is a revenue item. Mm-hmm. That's where you get to brag. That's where you get to have some fun.
Yep. And that's where a lot of people misunderstand the numbers. Okay. Mm-hmm. So when someone says gross revenue, they're saying the total amount of money that whatever company brought in. Sales, services, whatever. That's the money they brought in. When they say gross profit, that's the total amount of money that they profited on those sales or services for that month. That's the total. Now, you go from gross to net. Okay? Now, this applies to both. When you go to net revenue or net profit, usually is how the terms are, gross revenue, gross profit, net profit. You're talking about the amount that's left over after all of your deductions.
Now, what would be an example of some of those deductions in this situation?
So it depends on the company that you're talking about, but for a lot of people, that's overhead. And that's one of the other terms that we discussed. The overhead is the amount of money that it costs to run your business. And that could mean a lot of different things for a lot of different companies. If you're a lawn care company, it's the cost of fuel to go in the lawnmowers. If you're a coffee shop, it's the cost of, keeping the lights on in the shop and paying your employees.
All those coffee beans.
Yep. And that, for another day, we'll get into, deductions and all that and whatnot. But essentially what we're talking about is the difference between the total amount of money that you brought in compared to the actual amount of money that you're left with after you, pay your bills. Because a lot of people don't necessarily pay attention to that, right? They're like, hey, I just sold a job for, $2,000 or whatever. And then, but they never sit down and look and say, okay, well, it cost me this, and this. I had to pay that. Oh, this broke, so I had to fix that. And at the end of the day, it cost me $1,900 to do that job. And so your net profit on that project is $100. And all of a sudden, $2,000 sale doesn't sound so hot when it's $100 in profit.
And this is usually where there's a joke in the industry that you tell your friends your total revenue. You tell your wife your gross profit.
Your net profit.
Yes, thank you.
That's even worse.
Yeah, don't tell her that one. Sorry, honey.
Yeah, so and there's a lot of intricacies in that book working, that really the work of an accountant there. And a lot of people, they can do it on themselves, that's fine. But just understanding what those terms mean, especially diving into for what applies to your business specifically, all businesses, revenue, profit, and overhead, that applies to all of them.
Yeah, and in this example, we're using overhead and expenses virtually interchangeably.
Yeah, that's why I use the word deductions, because for some people, that can get really messy and get really complicated. But essentially, it's what it costs you to do your work. Yeah. Your liabilities. It's a loaded term, but
yes. And again, we're not CPAs, so
this is not financial advice.
Consult a professional.
Yeah,
but you should know, even if you're paying a professional, you need to have an idea what they're doing.
Yes.
So you need to know your revenue, net and gross, your profit, net and gross, overhead, rough estimates, and those kind of things.
Yeah, you just need to understand where your money's at, where you're getting it, and where it's going. So when you sit down with your accountant, or whether it's you, and your thing's saying, gross revenue, you know what that means, right? That's what we're trying to get to in this specific area, especially for small businesses. Because for Joe Schmo out there who just opened up his lawn care business, you may not understand what these terms mean or how they apply. So those are the few that we feel like are very important. You can get into other ones like accounts payable and receivable and that whole mess the further you go down. And at that point, we would highly recommend that you actually take a course on accounting or get an accountant or whatever. But at least for now, you need to know what those terms mean, and you need to be looking at those every month. How much money did I bring in? How much did it cost me to run the business, and how much am I left with at the end of the day? Because what you can do then, once you have those numbers, you can go to the next month and you can say, okay, this month it cost me less to run my business, or it cost me more to run my business because of XYZ. And then once you have a baseline of where your numbers are, you can tell when things are going differently than how they should be. If you have no idea where your numbers are at, and all of a sudden, the coffee shop's spending 3x what it should be on coffee beans, but you have no idea because you don't know what your overhead is. You just know how much money is left in the account at the end of the month. So keep track of those items specifically. There's plenty more you can keep track of, but at least your revenue, your profit, and your overhead.
I like it. Keep it simple. Again, you'll deep dive as you grow. But this is just starting out. Know the basics real quick there.
Yep, absolutely. Number 2. This one ties right into what we were just talking about, but essentially the difference between cash flow and profit, okay? Now, we didn't talk about cash flow in the last point because it wasn't directly tied. But cash flow, in the terms that we're going to be discussing it, is essentially money coming in and money going out. It sounds super self-explanatory, and on the surface it is. The cash flow of your company is just the money that comes in from the sale or service, the sale of goods or services you provide, and then the money that leaves your business by means of expenses and whatever else.
Coffee.
Yes. So, for most people, when you start a business, what's the first thing you're going to look at?
How much money is in my account?
Yep.
To work on this.
How much money is in my account? You have no idea what the cash flow for your company was last month. All you know is that last month you had $3,000 and this month you have $2,000. And you're like, what the heck? I had a terrible month, but I sold more than I ever have. How does that make any sense? That brings to the concept that we're discussing, which is cash flow is more important than profit on paper. So, like we talked about before, if cash flow is the money coming in and out of your business, and profit is the amount of money that you're keeping after you deduct your overhead and expenses, why would cash flow be better than profit?
Now, as I'm understanding this here, cash flow means you are correctly timing the money coming in versus the money going out.
Cash flow done well.
Yeah.
Yes.
Yes, it means you're accurately pulling out enough or saving enough from each job to maintain the books. So, for example, maybe your reserve in the account only has enough in there for you to run one job to completion and paid at a time.
Yes. That's exactly what we're talking about. And I think maybe this is best explained through an example. So let's go back to lawn care, okay? We've talked about that before. Cash flow for a lawn care company would be, okay, I have 10 accounts that I'm mowing lawns for, and I get paid, $50 a piece for that, okay? So you're bringing in $500. The cash flow out would be, okay, at the end of the month, I spent $150 on fuel. I spent, X amount on maintenance. I spent whatever. And I also had paid labor. I paid taxes. I paid my subscription fees, my website fees, all of that. Okay. You made $500 and you also had all of the money that left your account, but you're getting paid weekly. So you're getting, $500 a week, $500 a week, money in, money out. Why that having a good cash flow is better than profit on paper is because in terms of lawn care, say you mowed those $500 worth of places and it costs you that $150 worth of fuel, X amount of all those expenses I just listed off. But your customers haven't paid you for last week and your bank account is sitting at $50 and you've got to go mow 10 more places next week and you don't have the money to put the gas in the lawnmowers, the profit you made is technically $500 in sales because you're selling your service per week at $500, but you haven't been paid for last week. Now, you made the sale, but you don't have the cash flow.
Mm-hmm.
And that's what we're talking about.
Yep, you have to have this timed properly. This is very common for quickly growing businesses to get ahead of themselves.
Mm-hmm.
Basically, they have, especially if you're dealing with your first or second larger contract, and if it is either with a large company or the government, their payment structures might be net 30, net 60, net 90.
Yep.
And they have months to pay you. And then what are you going to do? You're going to foreclose on USPS? You're going to send them to collections? No. You're going to be patient and you're going to wait for them to pay you.
Mm-hmm.
So even though you have a contract, who says, "Hey, I'm going to get paid. I did my job." But you have no cash flow.
Yeah. And on your profit and loss statement, which we'll talk about later, you made profit of whatever those sales were. But yet you look at your bank account and it's negative $5,000.
Yep.
Cash flow is more important than on paper profit. Mm-hmm. And especially applies to like companies that are doing inventory items. Like say you start an Etsy shop, right? That would be a great example for somebody. They make crafts or whatever, okay? And you had 300 orders come in, right? That's just arbitrary number. 300 orders come in, right? Man, I'm getting all these sales. Wonderful, wonderful, wonderful. Okay. And then you make all of these items and you ship them out. Wonderful. Business is great. Wonderful. Well, guess what? Now you just got an order for 500 more and you don't have the money to buy the supplies.
Mm-hmm.
Because you're still waiting for those last 300 orders that you made and shipped out, but you haven't gotten paid for because they haven't delivered. Now, what are you going to do? You have to front those 500 orders of supplies, or it could be 5 orders, whatever it is. But companies that have inventory, they'll either not have enough inventory or the capital to buy for future, or they'll overstock their inventory to where they've spent all of their money beefing up their inventory so that they can make the sale, but then they didn't leave themselves enough money to pay for their overhead. Mm-hmm. They can't even turn the lights on at the shop because they can't pay the electricity bill. They've got inventory sitting in the shop, but they can't ship it because they can't pay the bill to ship it.
Mm-hmm. And you'll see this with either small or larger stores. If all of a sudden an item that has just been not selling just gets marked all the way down.
Yep.
Basically, they're like, look, I have space in my warehouse. My warehouse needs used with something new that's going to bring me better profit. Get this out of here.
Mm-hmm. And there's a lot of like details and intricacies of the accounting process that we're leaving out. And
Absolutely.
We recognize that. Like there's a lot more to this than what we're saying here, but we're trying to keep it simple for somebody who's just starting a business. Mm-hmm. And essentially that is you have to time the money coming in with the money going out, rather than just focusing on making profit.
Mm-hmm. And because I have some people who I know, good friends, and they are investing everything back into the business. I know their profit margins. They're phenomenal, but they are, because of how their cash flow is, all the time, their accounts are like almost zero.
Yep.
Because it's just horrible timing. And it's like, guys, when are we going to get a good reserve here? You need a reserve.
Yeah, and it's especially on those ones that like provide. Well, I shouldn't say especially, but like this comes to mind for me personally. Someone that provides a service, especially if you're doing a contract that's net 30 or net 60, you could end up you could do 60 days worth of work without seeing a dime from day one until after those 60 days of work are done. Or say you are a small business and you're like, hey, that's a contract I want to go after. Well, guess what? You can't because it pays on net 60 and you can't afford to pay for that 60 days of work until you get paid from that contract.
Mm-hmm. You need, in that example here, you need at least 60 days of cash in the bank just to attempt to go for that contract.
Yes, and if you don't know that ahead of time, you could go and get that contract and then be liable for 60 days worth of work without even knowing it.
This is where read the fine print. This is usually why sometimes only bigger companies get those bigger contracts. Well, sometimes they just have the reserves to get through. I mean, 60 days, that's almost a winter. So,
that is.
Yeah, so like anyone who does, usually if you do lawn care, well, you're probably not doing lawn care in the winter.
Yeah.
So what do? You shovel.
Yeah.
And
now lawn cares aren't paying on net 60, but
yeah. But these are the items where you got to be thinking about that next portion of it, where it goes back to another principle we've talked about: have a good emergency fund, even for your business. Businesses should have an emergency fund too.
Yep. We'll get into that in a minute. But cash flow. Track the money coming in and out of your account and plan for the future. Okay. Number 3 is, how should I describe this? How to sell what you sell.
How to price it, you mean?
Yes. How to price for profit. Is that a good way of saying that?
I like, yes. Price for a healthy profit. I'm going to make a giant statement here. You deserve more money.
Yeah.
Okay?
Odds are you are underpriced. Not always, but if you are a small business just starting out, you're underpriced.
Now, the easiest way to know if you're underpriced is just to look at the market average. There's your starting place. And then say, is my product better, worse, or average? And then you can adjust from there. Now, just because a large company has a particular price item, and you're like, well, I'm the new guy in town. I'm on discount on my stuff. Do you give a better product? Should I expect less of you? Or do you have so much pride in your product that people would be willing to pay a premium? Because even if, let's say we're selling the same exact item, and it's you and me, we're selling something, and then you have Walmart selling something. What's the difference between Walmart selling it and us selling it?
Yeah.
If something breaks at Walmart, best of luck getting someone to help you out. Nothing against Walmart there.
Yeah.
If we sell you something and something breaks, hey, how you doing? There is a unquantifiable, but oddly enough, you can put a number on it, benefit for you personally being involved in the sale.
Yeah, absolutely. And obviously this changes with the business that you're in, but especially companies that are just starting out as a small business, they almost always underprice whatever it is they're providing. Whether they're selling something and they're undercutting their competition, whether they're providing a service and they're underbidding or whatever it is to try to get work. They're like, oh, I want to get to work, so I'm gonna go cheap, or let me try to just sneak in underneath the other guy. Fine, but you're not going to be successful that way in the long term. In the short term, it'll work. You'll make razor thin margins, and then you'll wonder why you're even doing it.
And then you might attract the clientele who only goes for the cheaper deal.
I was going to get to that, dude. This is like one of my biggest pet peeves in business as a rule. You get what you pay for. And yes, someone can give me some abstract analogy or situation where they got a good deal on something or they went with the cheaper option and it paid out. But as a rule of thumb, you get what you pay for in anything. And that specifically applies to small businesses pricing their goods and services to clients. And if you price that low price, you're going to attract low customers. And trust me, you don't want the low-paying customers.
No. If you want to make a lot of money, you can do it a couple ways. You can do a lot of little sales, or you can do a few big sales.
Yep, supply and demand. But yeah, it essentially comes back to how you're pricing your product, okay?
one thing that I talk with people about on this one, it's very common. People have a guilt about actually properly pricing their product. And it's for one reason. They say, well, I wouldn't pay that. Okay, but you're not your client.
Yes, absolutely.
If you were your client, you wouldn't pay anybody because you can do the work.
Absolutely.
What the fair market price is what someone is willing to pay. End of discussion. At the airport, a bottle of water is not appropriately priced, but it is priced appropriately.
Absolutely. You said exactly there, and it goes back to what I just touched on it. But supply and demand, and that sounds like, how does this apply? If someone is willing to pay for it, then it's worth that amount of money. And if you can make fewer sales at a higher price, you will make more money selling fewer at higher prices than you will selling fewer at lower prices. Mm-hmm. You will be happier, more successful, and more profitable pricing your product higher and making less in sales. And a great way to test this is increase the price on what you're doing and see how many people still buy it. Because if you're making 10 sales a week at X amount, at 10 sales at $100, and you can drop that to 5 sales at $200, you're making the same. Is that right? Is that money? Is that math check out?
Yeah, still $1,000.
Yeah, you're still making the same money on half the work.
That is huge. And you're like, well, look, some people say, well, I lost 5 clients. No, you kept the 5 you wanted to have.
Absolutely.
You just didn't know that those were the 5. And let's say we do an item that's a bit more transactional, a little more frequent. Let's say you raise your prices 10%. But because you kept good numbers, you know that you lost 5% of your clients. That's okay.
Yep.
Because one, you charge a more fair value for your product. You took a bit more pride in your product, and you only lost 5% of them, but you made 10. You were increased it by 10, so you actually netted better there.
You're exactly right, and that goes back to you can't do this if you're not tracking your money, which was point number 1. If you don't know where your money's at, you can't make a shift in price and then track the result if you don't know where you're at in the first place. Which means you're probably underpricing and not making the money that you could be. And in the beginning, everybody just wants to get the sale, but they don't understand what that implications that has for future use.
Yeah. Secretly, everybody has an ideal client, and you do not want to attract the least ideal clients.
Yeah. And for some companies, running those razor thin margins works, right? That's their business model. It works for them. But for a small business starting out, for most of those businesses, you will be far better off. Even just as a business owner, your mental stability will be far better off if you just let go of those few low margin sales that you're trying so desperately to hold on by cutting your price.
And especially when you're in the start here, every client feels like part of the family. You're just so proud of every sale, and you should be proud of every sale. But one bad client is so much worse than 5 decently good ones.
Yeah. That one client or whatever, that one sale that you're chasing will end up costing you way more than just letting them go. And that, as someone starting out, that's bizarre to hear, because you're like, I'm just trying to make money. I'm trying to make money. I'm trying to make money. That's not always the number one goal.
Your product is for who it's for, and it's not for who it's not for.
Mm-hmm.
And sometimes the best way to find out is who can pay me? Who's got my money?
Mm-hmm. Yep. You're exactly right. This takes us to our next point, which is building some financial systems and habits that help you run your business smoother. Okay. So we talked a lot about keeping track of all of your money. We talked about knowing where you're at, how to price, how to change your prices, why you should price it the way you should price it. But how do you make this process easier so that, like you said in the beginning, you can still do what you love and not become a full-time accountant just to own the business?
Mm-hmm.
How do you do that? Number one, I'm going to put out a recommendation of use some sort of accounting resource, okay? Whether that is you hire an accountant if you can afford it, whether that is if you don't want to hire an accountant, you want to use some sort of software. QuickBooks is amazing for small businesses starting out. Or even if you don't want to use pay for a software subscription that'll do it, and at a minimum, get in the habit of working out a respectable system on some, like, at a bare minimum, some spreadsheets.
Mm-hmm.
Absolutely. At a bare minimum. But some accounting resource, okay?
Mm-hmm. A uniform way that you keep track of the money that came in, who still owes you money, and money that went out.
Yep. When you're first starting out, an Excel spreadsheet and some notes and, your bank statements may suffice, okay? That's fine. Understandable.
Now, you did mention something there that should probably be addressed.
I'll get there in just a second.
I'll get there. I'll get Nancy.
As you grow, I would highly recommend that you save yourself some time and headache by investing in something a little bit more productive or efficient at doing those accounting things. Mm-hmm. Personally, I'm going to do a plug for QuickBooks.
Yes.
We're not sponsored by QuickBooks, but they do they pretty much own the market in this area, but they do a fantastic job, especially for small businesses.
And the baseline QuickBooks is probably less than $10 a month, I'm guessing.
I think it's a little, it might be like $20 or $30.
Even so.
Like,
so and as we're talking about business owner, you got to know your calendar.
Okay. So
tie it right into QuickBooks here. Let's say QuickBooks eliminates all your paperwork down to, we'll call it an hour a week. Okay? For example. Mm-hmm. And then you attempt to do it without QuickBooks. Mm-hmm. And all of a sudden it takes you 2 hours a week. Okay? Mm-hmm. In a month, that is 8 hours you're going to spend doing it. Now, let's say QuickBooks, let's say high end, $30 a month. It's not, but let's just say it is. Is $30 a month for 8 hours of pain worth it to you?
Even an hour.
Yeah.
If it saves you an hour per month, it's making its money. Not only because it's not only the time that you're saving, but the organization and how should I word it? Ease of use.
Yes. QuickBooks, they basically own most of this market here. They partner with everybody. It syncs with your bank, your credit card. Dude, it just
so
works.
Easy to use. And it's a fantastic way to keep track of your records. Because it's all in
and
one
someone
spot.
else is doing it.
Absolutely. So if you don't want to do QuickBooks, hiring an accountant is another easy option. Usually that's a little bit even more pricier, but you get like that personal involvement. That's also a great resource because you can get advice from them and whatnot as well. But having some sort of resource to keep your accounting, because again, you're not, unless you're an accountant, your business is not accounting, and you want to spend as little time while still accomplishing what you need to on the accounting. And having some resource to do that efficiently is a must. And a lot of people don't want to invest in that starting out, but trust me, it will pay itself off later.
It's one of your cheapest investments with your highest ROI, return on investment.
Yep. Now, he was getting to it a little bit earlier, but the next step in this is opening a bank account and credit card for your business.
Mm-hmm.
Now, for a lot of people, may not be self-explanatory. But if you opened a company, I don't care what kind it is, if you started a company, it needs a bank account.
Mm-hmm. It needs
Period.
its own separate, not you, bank account.
Yep, absolutely. On the check, it needs to say the name of the company.
Yes.
It's and there's a lot of reasons for that, but the main reason is that it keeps you separate from your business in terms of finances. And there you will never regret doing it. It costs almost nothing, essentially, and it will do nothing but help you. And we touched on this a little bit in one of our other videos on this, but you have to have a separate bank account. We talked about that accounting resource, right? QuickBooks. You've pretty much eliminated the use of that in your bank account if you don't have a separate bank account. Because now you're trying to use QuickBooks on your personal account, and now all of a sudden it's trying to sort, which it won't. It's not going to do it. Your personal, Netflix subscription
as a business
expense, and you're going to
It
spend.
was for education, IRS, I swear.
You're going to spend more time trying to split those two apart than you would have if you'd have just done the accounting yourself.
Mm-hmm.
So,
and again, hinting at that other video we did here covering structures, commingled funds may not fare well for you in a lawsuit.
we're just going to say it's frowned upon.
I wouldn't recommend it.
Yeah.
Don't give the other side ammo, please.
This is one time where we're just going to say, here's a bunch of reasons why, and then if nothing else, just trust us. Just open a bank account. Because worst case scenario, you just close it.
Yeah.
Your business goes under, you just close the account.
Yeah. End of story. Easy stuff.
But now,
you mentioned a business credit card.
That's
Why
what
did you
I'm
mention
gonna do.
that?
Business credit card. Okay. We put this one in as a must, okay? Some people disagree on this. I'm kind of in the middle, right?
Mm.
I think it's a great idea. Do you absolutely have to have one starting out? Probably not. But there are benefits to it.
Mm-hmm.
So, to a lot of people, they're like, credit card? I just started out. I've got $20. What do I need a credit card for? The idea of the credit card is not to offer you an avenue to get a hold of borrowed funds. That's not the point to start with. Okay? Don't go get a business credit card so that you can go spend $2,000 on a bunch of new equipment for your company if you don't have the money to pay for it.
Mm-hmm.
Don't go get a credit card so that you can just go buy a bunch of stuff that you want for the business if you don't have the money for it. The point of the credit card is to offer you the flexibility to buy those things without the immediate access to cash right now, right this second.
Mm-hmm.
So if you're going to go buy that new equipment because you have the money to pay for it, but you want that ease of access to the money or flexibility on using it, that's great. But if you have $20, don't go spend $2,000 on stuff that you can't afford to pay for with the credit card. That's not the point.
Mm-mm. And often here, this is where basically you get to treat your own expenses on a net 30 effectively
Yes.
for yourself. If all of your contracts, all your suppliers, they'll have 30 days. Sorry, all of your customers have 30 days to pay you, and you have a business credit card, you're pretty close to giving yourself a net 30 on your expenses.
Yes, it gives you that access to cash flow, like we talked about to begin with. For example, if you need to go buy new equipment, like I mentioned, for a project, and you are going to get paid for it, you just don't have the money now, the credit card's a great option. You go, hey, I'm going to go drop $1,000 on some new equipment that I need that I've already signed a contract for, a project that I'm going to get paid for. Fantastic. But don't go spend $1,000 and then be like, all right, let's go get some work. Let me go see if I can get some sales to use this equipment. I got $20 in the bank account. I hope I get it. That's not what it's for.
And this is one of those really good examples where, let's say you're like, oh, I assume everyone's going to pay me on net 30. Definitely read your own fine print or be prepared for them to take longer. So still have your reserves. Because at the end of
flow. Cash flow.
Yeah, because at the end of
cash flow.
It's just so true, though. You have to have this because regardless of whether or not your client has paid you, you still owe on the credit card, and then that can spiral. So really, you still need your reserves. You need to be prepared, even if your client has a bad day.
Absolutely, and the credit card can offer some great flexibility on that, and it's a tool to be used. And each business is going to be different, but essentially, the credit card offers you flexibility in terms of cash flow. It's not a free spending spree.
No, please don't.
Now, I want to touch on something that you just mentioned there, which was having some reserves. We've mentioned it a few times throughout this, but when you're just starting out, it's hard to get a hold of some reserves, right? Especially, you just started the company. You may not have a lot of money. You're trying to get those few first sales, and you need that profit to reinvest into the company. Okay? Where do you draw the line on I need to invest this money back into the company versus I need to set this aside for some reserves?
That's hard because money you keep in reserves, and again, your tax cal will go into this, often gets taxed as opposed to money reinvested back in. You may not get taxed on it. There's a whole real delicate balance on that. It's not a bad idea to have like a percentage in your head. A percentage of each job or percentage of each profit goes into my reserve fund until I hit XYZ. Now, I also assume that for the first starting out business owner, they still have a normal job. This is a side hustle to start with. Because if you place yourself, let's just talk about the emotion of this for a second. If you place yourself in a place where you have to make this sale, you're going to get desperate. And then you're going to get emotional. And you're like, oh my gosh, if I don't make this sale, they won't do it at $1,000. Well, we do it at 9, we do it at 8, and all of a sudden you're like a motivated seller. And then someone's just waiting for you. No, you need to be having on the back end. I usually say if you don't have enough reserves to even start the company, you're not ready to start the company yet. Just a little bit of something.
I don't know that I would agree with that.
Okay.
But let me throw you this pitch out here, okay?
Go for it.
And I know a lot of people will probably disagree with this. But when you're starting the company, especially when you're just brand new off, you should have, and this is how much I would recommend, because you shouldn't overhold reserves when you need that money to be reinvesting in your company. You should hold enough in reserves that if everything went to crap tomorrow, you could walk away.
I like
$0.
that. I like that. These are called retained earnings, by the way. That's the term we're looking for.
Yes, retained earnings. But essentially, if everything went to crap, you made 0 sales, all your bills came due, and you had nothing coming in, you could just walk away.
I like that. Because there's a peace of mind with that.
Yes, because then you're not put in that desperate situation with, I have to make this sale. Now, you might be like, I need this sale in order to, progress or get bigger.
Sure.
But you're not in the situations where I'm going to lose my pants because I don't have any money. And especially for a small business, usually the amount of money required to walk away is not a lot. Because usually all you have to, your consistent expenses are for the specific job or product that you're trying to sell. So you need enough to cover whatever your, card statement is for the last amount of inventory that you purchased, or you need enough to cover, the rental fees for the project you're doing, whatever it is, something like that. But essentially, if everything went to crap tomorrow, you could just walk away.
I like that idea. That's a very solid idea because that's also very good on the personal side.
Yeah.
Have enough that a big, bizarre event doesn't just empty you.
Yeah. And the reason I say that is you'll hear a lot of people who are like, and I know, Joseph's is a big proponent of this, but, have that 3 months of operating income, which is a fantastic idea if you can handle that. Mm-hmm. But especially if you're a company or you're a business that's just starting out, if you have enough that you can just walk away tomorrow, you don't necessarily need 3 months worth of operating income.
Right.
If it's your first year or first 6 months.
Mm-hmm.
You may not necessarily need all of that. That's a great place to work towards, but at least if you have enough that you can walk away, you can sleep at night.
Especially if you don't have employees, especially at the beginning here, it's really just enough where you can walk away. Once you've established, down the line, have the good reserves. That's wonderful. But at the beginning, look, just have enough to get you through. Because you don't need to overcomplicate this with everything else. Because one of our other ones was just get something available, get a product, toss a price tag on it, and go. Yeah, that's this beginning stage here. Then the slight maturity is, okay, I made this much. This much goes toward reinvestment of the company. This much goes toward my pot of money. And just keep on working those.
Yep.
And that's why there's no set dollar figure on these.
No.
You can look online and find some general principles that maybe fit your industry a little bit, but it's all very tailored toward you specifically.
Yeah, and really, like, at the end of the day, a lot of this is like, accounting, money, finances. Once you get going, you learn, you grow, you'll get it figured out. These are just some basic principles to get you started. Don't get overwhelmed. You'll be fine. Yep. Just have fun, man. Running a business is the greatest and hardest thing you will ever do. So
I'm sure people who have a lot of kids like to say that that's the hardest and greatest thing they've ever done. But honestly, a small business, it's your baby.
Yeah.
It's gonna ask for your blood, sweat, and tears. It's gonna make you cry. It'll keep you up late at night. Oh my gosh, it is a kid.
Yeah, you're not wrong. So yeah, have some fun.
Have some fun.